Assalamu alaikum. Good afternoon, everyone. Before we start, I just wanted to confirm that we are CS as well. Can somebody confirm that? Pavitra, can you hear us?
Hi, sir. Yes, sir. Good afternoon.
Okay, so we will kickstart the MSX discussion session for the full year ended 2023. We're just now posting the slides on screen. Can you see the slides? Everybody is passing or what?
Yes, it is visible.
Slides visible to everybody? Okay, fantastic. Okay, so we'll go through the agenda and then we get into the details of each of these agenda. So number one is the highlights on the board of directors. Then we'll touch upon the organization chart, snapshot of financial performance, and then comparison between 2023 and 2022. Keeping in mind the IFRS 17, and we'll touch upon that in the following slides. Then the mix of gross written premium as well as underwriting income between the various lines of business and insurance. Then we will highlight and touch upon the our investment portfolio and how it transformed between 2022 and 2023. IFRS 17, which got successfully implemented across the industry. What were the implications? And then finally open the floor for questions and answers. If we're all happy with the agenda, we move into the first item, which is board of directors. There has been no change in the board of directors since the last election 2 years ago. So His Excellency Khalaf Al-Manna'i remained to be the chairman of the board of directors. And why I'm touching upon the board of directors? Because we had a merger in between, so nothing was changed or no structure was changed with the board. Mr. Musallam Maqad Al-Fadl was and is deputy chairman of the board. Mr. Ali Saad Al-Fadala, Tariq Razak Al-Shamla, Mr. Salim Al-Manna'i, Mr. Abdullah Al-Khunji, and Mr. Saeed Al-Muhannadi, all with the same roles and responsibilities to the previous sessions we had. There is no change in the management as well since our last meeting. So this is the top management of OQIC, and all of us are present in today's session, and we'll be happy to interact and answer any questions should you have. Okay, so we'll go to the performance now. Before we get into the details of each of these comparisons and squares, just a note on the right side. The result for the years 2022 and 2023 is based on the accounting standard of IFRS 17, whereas the 2021 and 2020 were based on the IFRS 4. So the shift, or let's say the 2022 and 2023 apple to apple, and 2021 and 2020 is again another apple, or let's say orange to orange comparison. And another point to highlight here is that the 2022 result is the restated figures based on the IFRS 17. So obviously last time what you have seen and what we have published was the IFRS 4. And just to give an example, in the year 2022, the gross written premium was 37.6 million Omani riyals. Whereas as for the IFRS 17, the insurance revenue is 35.2 million Omani riyals. And I'm sure all of you know the impact and the calculations of the insurance revenue, which is the gross premium minus the gross UPR as well. Now, having said that, 2022 and 2023, we have seen massive growth from 35.2 million to 63.7 million. And in the following slides, you will see where and which lines of business have contributed to this growth. But you all know that merger also did play a role in growing our portfolio. When it comes to the underwriting income, again, the same result, 2020 and 2021, let's say oranges to oranges, and 2022 and 2023 apples to apples. So the performance of the previous, the 2020, 2021, we've seen it was flat, and we have seen a slight drop in the insurance service result. Again, this is not underwriting income. This is the insurance service result, which I'm sure now most of you, if not all of you, are well familiar with that. And if you have questions, maybe at the end of the session we can address your queries and explain very, very high level what are the differences. So what matters in this chart bar is that there has been a slight drop in the underwriting income, in the insurance service result. And I would say that claims did play a role. The increase in the claims, again, the business has grown massively. Also, the shift in portfolio towards a more retention lines of business like medical, and as well as the transition and in the whole journey of OQIC post merger and all the way throughout the integration. Profit after tax, again, I'm not going to repeat, it has been flat for the 2022 and 2023. If you remember 2022, based on the IFRS 17, it was around 3 million, 3.1 or 3 million, which was flat to 2021. But again, the figures in 2022 got restated as per the IFRS 17, and then we have seen almost a 1 million hike in the profit of 2022. And 2023, despite various challenges, despite the merger, despite the impact of UPR, and you will see later on, despite the huge hit that we have taken on the tax, we managed to slightly grow, I think 0.5%, some 30 or 40,000 riyals higher than last year. But overall, we managed not to deliver lesser than the restated profit after tax of 2022. Otherwise, last year was around 3 million. And investment income, we've seen again a steady growth. Between 2021 and 2023. And this is the only bar chart that has no implications of IFRS 17, so it doesn't matter whatsoever because it has not impacted the calculation and the portfolio investment. But from the years. The last 3 years, 2021 all over 2023, it's almost flat. Despite the markets have dropped heavily in 2023 when compared to 2022. But with our strategies and the not only strategy but also the growth in our investment portfolio. Actually, the performance has deteriorated because of the markets, but then the investment has grown. The investment book has grown. Beyond the last year because of the merger, but overall the income from that, is almost flat. Before I hand over to our CFO to walk you through the ratios, again, I don't want to repeat what we have said in the previous slides. Now you can see that, and variance is very clear. But I want to touch upon maybe 2 or 3 items here. One is the G&A expense, including depreciation. So in 2023, we are seeing nearly 86% growth in increase in our expenses, and that's very, very natural, due to the merger that happened with Vision Insurance Company. In the figure that is in front of you, 2022, which is 1.1 million Omani riyals, that is OQIC standalone before the merger, and 2 million is the the new entity or the merged entity post integration. So that's 86%. And as well as you've seen, there's a massive growth in our revenue streams. So from 35 to 63 billion, and there were a natural increase of the natural cost of running the business, and that has an impact. So there's nothing major. In fact, the growth is slight, despite all the merger expenses as well. Is in my view, in my reading, is quite reasonable. Second item is the net profit before tax. So now if we exclude tax for a moment and look at the profits before tax, we have seen a 9% increase in our bottom line, from 4.39 million Omani riyals to 4.77. So I would like to assess our performance as well on this important item, which is before income tax expense, because it tells all the activities that has taken place throughout the year 2023 across different streams of revenues, be it insurance related or investment. And we have seen that the investment income has seen slight drop. But there's another item, which is the one-off merger gain, let's call it bargain gain, if you will, around 1.8, if I remember correctly, 1.9 million, which has classified as other income, and that's why you see that there is another growth in that item. Now, in the income tax, the entire 1.9 million bargain gain got taxed. So that's an important element to keep in mind why the income tax has grown. And second is the transition between IFRS 14 and IFRS 17. It also changed a little bit the ways we calculate the tax. Some impact was there, and of course the integration as well. So I just wanted to highlight these points here, and I'll now hand over to Mohammed Jawad to walk you through the following agenda items. Thank you.
Thank you, Mr. Hassan. So taking you through the key ratios and other details related to the performance. So starting with a note that the year 2022 and 2023 again are based on IFRS 17. So 22 was restated. Prior years are based on IFRS 4. Going to GWP mix, we can see that in liability lines in 2023 it contributed 11% from the total top line insurance revenues, compared to 6% in 2022. So we witnessed almost double business in liability lines. Compared to property, it dropped. So in property, last year, it contributed 56% of our top line. This year, it is 31%. Other lines are plus minus similar. Only life and medical, we witnessed a big growth. So it contributed to 36% of our insurance revenue in 2023 compared to 17% last year. A point to highlight here is that the company's strategy is not to focus on one line of business, and that line of business will have the massive weight on our top line insurance revenue. So our strategy is to diversify our business and to focus on profit-making lines. So that's why we can see we dropped in property, we increased in medical, but however, we are maintaining. Last year it was 56%, which was high to count on property, more than 50% of the total company top line. Going to combined ratio, so in 2022-2023, we have calculated the combined ratio based on the new IFRS 17 mandates. So basically, this is insurance service result divided by insurance revenue. We can notice that it increased from 93% last year to 97% this year. And there are many factors that contributed to this increase. Major factors are increase in expenses, one-offs related to the merger, other expenses happened in this year due to the merger, and the increase in claims in medical business and motor business. Going to the third slide, the third graph, return on equity. So we can see that the company gradually is increasing in terms of the return on equity ratio. So we started in 2019 with 8%, went to 12, then 15. And in 2022, it was the highest, 19%, but it was on the old capital of 10 million Omani Riyal, which now increased to 22 million Riyal. However, the company managed to get a return on equity of 11%, which is a very good return on such capital. Moving to the last graph, net asset value, we can see that there is a steady growth every year. So starting from 165 in 2019, we reached 29 Beza in 2023. If we go to the our CEO mentioned that the investment for this year was almost 2.8, 2.9 million. So the the composition of our portfolio and the investment income is in this slide. So when we compare 2023 and 2022, we should notice that the company started to move from equities and to create a more balanced portfolio. So we can see that in 2022, for example, the equity investment, realized and unrealized portion, which is earning from this equity, the equity was 38% of the portfolio, compared to almost 40% in fixed deposits. But when we go to 2023, we can see that equity weightage reduced. So equity is now 24%. And we have mutual fund of 7%. So we decreased our equity investments and we increased our fixed deposits and bonds.
So the ratio of what we use on a bigger portfolio. So
Yes.
all the new investments are more into the fixed deposit. So we are not selling all our equity to move into the fixed deposits as much as the portfolio has increased. And the more of the new investments get into the earnings.
Yes. In fact, post-merger, the combined portfolio was having little higher weightage on equity, which we managed to reduce. So the aim of this is to have a more portfolio that suits insurance industry. So that reduced the fluctuation in investment return. So now we have this portfolio and we are enhancing it more in 2024. In terms of returns from the existing portfolio compared to last year, we can see that 22% was the dividend income, amounting to 627,000 riyal. 60% was our earnings from the interest income, 1.76 million Omani riyal. And we had almost 1% from rental income, and 17% was 500,000 riyal, our realized and unrealized income. So when we compare this with 2022, where we witnessed the impact of equity markets and the bearish market in 2023, we can see that last year in 2022, our realized and unrealized gains on equity amounted to almost 1.5 million riyal of our total investments. And interest income was 30%, around 890,000 riyal. So we can see the big shift from 890,000 riyal to 1.76 million this year. And of course, our interest income also contributed. Going to the solvency position. So maybe some of the analysts were asking post-merger with Vision Insurance, what will be the solvency position of OQIC? As per Capital Market Authority mandate on decision number 18/2022, where all insurance companies started to calculate the solvency margin based on risk solvency. Solvency margin is a good indication that how the company can pay their claims, how the company is capable. So the higher the ratio, the stronger is the company position. So the minimum solvency requirement as per RBC should be 4 million riyal for general insurance, 2 million riyal for medical, and 1 million riyal for life business. Total shouldn't be lesser than 10 million Omani riyal. So when we consider our overall surplus from this 10 million riyal, we recorded a surplus of 29.2 million riyal. That means our total solvency was 39.2 million riyal. If we compare 2022 standalone figure, we were 12.8 million riyal surplus. So together it was 22 million 0.8. So this indicates a strong solvency position where we are more than double, and the company is well capable to honor all liabilities. With this, we can conclude our presentation today and open the floor for the questions.
Thank you, Brother. Any questions from the audience?
Somebody question?
Yeah. Go ahead, Vinu.
Thank you for this presentation. I think it was a very detailed presentation. I really appreciate it. Just a few questions. If you could just, you mentioned about your combined ratio, and I think the company's done a great job in sort of maintaining a combined ratio below 100%. Kudos to you. If you could just give us a split up of the sort of individual line items in terms of your loss ratio, expense ratio, commission ratio, it'll just help us further break it down, because as per the IFRS 17 reporting, firstly, I'd just like to comment that you're the only company that's been able to give us a combined ratio straight up instead of calculating it from the statements. But if you give us a further split up, it will be helpful.
Thanks, Bishan. It's a very nice question. I don't have the information with me at the moment, right? There's too many figures I've gone through. But let me give you the following views. So if you have seen the performance of all the listed insurance companies in Oman, and mainly those who have adapted the IFRS 17, except the two capital entities, you will see that we are perhaps, and of course, there's one entity which is the largest in this market. If you take the parents, not the group results, only the parents group, you will notice that we were the only insurance company who posted a positive insurance filings result, in the market. So, and I was happy to see that, despite the different challenges and despite the entire integration happened. Now, what I can tell you in terms of again, because combined ratios again for IFRS 17 differs from IFRS 4. I remember the IFRS 4 on top of my head because most of the software that I use on daily basis is on the IFRS 4 until the new reporting is completely ready. But on the underwriting income side, all three pillars of business, which is the personal lines, on the underwriting income, personal lines, commercial lines, and life and medical have posted profits. This is the underwriting income. The vast majority of contribution came from the commercial lines, and specifically from the engineering lines of business, as well as liability and miscellaneous. Property did post a positive, both positive NOI and positive underwriting income, but not to the extent of the other lines I mentioned now. Medical also, posted a positive underwriting income, but not enough to cover up all the expenses. And when I say expenses, I also include the one-off merger expense, which is around 900,000 Omani riyals, give or take. So the NOI based on the IFRS 4 for life and medical, and for medical, life was positive, for medical was negative. But if you're asking for IFRS 17 now, I have to go back to the other documents. Yes, Bishop.
Noted. Thank you so much. Next question would be in general, with respect to what's happening in the market on the motor segment and the life and medical segment. Now, I noticed that you've taken a bigger exposure to the life and medical segment. So if you could just talk about sector-specific loss ratios with regards to motor, life, and the other segments, please.
See, for motor, again, I assume are you differentiating the motor retail, which is the individual, versus the fleet? Because what we are seeing in this market for fleet, the competition is unbelievable, and the rates are extremely thin, and also the minimum premium for the comprehensive within the fleet is crazily low, right? So that's not. I cannot speak about the investment report loss ratio. I don't have access to that information, but I can tell you that it did not work well for us in 2023, the fleet element, because of the rating. And on the retail individual, again, what I'm going to say about 2023 might not be accurate because it is a merged book with Vision. And if you remember the loss ratios for the Vision Insurance Company before merger was, extremely high, perhaps 125% or so, if I remember correctly. So when merging these two entities, the reserves together and all of that, it deteriorates. But it was around in the 80s. So the merged entity, the loss ratio for the merged entity in 2023 for motor was in the 80s, whereas in 2022 and before it was much lower than that. For life and medical, it's always for us, it's always below 100%, the loss ratio, and we maintain that. What we have seen, the massive change or the impact of life and medical mainly, is the impact of UPR. You have seen there's a huge growth in our top line in medical, and our retention, I've mentioned earlier, I'm not going to repeat now, it's on a higher side. So the UPR it impacted us. But then if you look at the loss ratios, we have seen a steady kind of picture between 2022 and 2023. And it's worth noting that the contribution from the Vision's portfolio in medical was modest. However, the contribution from Vision on life was very positive, and that has improved our performance in life, group life, and credit life versus last year.
Noted. So to sum up, let's say for FY24 or FY25 for the combined ratio, what sort of loss ratio and target combined ratio are you looking at?
So we are looking at, we have a bit ambitions, very ambitious targets, have been imposed to us on us by the board and by the group. So, we are looking at, not more than 95% combined ratio for the year 2024. And, the mandate is to really grow, obtain or get profits from the life and medical and the personal line. So that's the mandate and that's the focus for us. So the focus is not on the top line, the focus is on the bottom line for these two pillars.
Right, got it. And could you just comment on premiums, because we are aware of sort of the premiums being extremely price sensitive in the market, but as a strategy, I remember you mentioning that the company would be more bottom line sort of oriented rather than just growing its top line at a loss. How are you seeing premiums evolving on the motor space, and sort of what is the outlook on that for this year and beyond?
See, I told you, we have posted, the performance in 2023 for motor was not good, mainly from the fleet side there. And then again, it was merged with Vision portfolio, did not post a very good result. But if you look at our rates, let's speak about third party. We are among, let's say a category of companies with higher premiums versus the market. So a few companies are above certain standard kind of rate, and we are among these people across, and we don't differentiate between renewal or new business. When we make a decision to lower the premium, it gets at a portfolio level. But what we have seen in the market, some few insurance companies claim that they have increased their rates, and but that's for new business. And that the frequency in third party is low. The accident frequency. So if we assume that the frequency for the industry is 5%, means your 95% renewal book will not be impacted, in terms of the rate. And then if you are retailing on the 95%, 50%, it's a big, kind of chunk of your business, which are not being exposed to the new rates, right? So it's a strategy followed by some of our competitors, but in our case, we apply across so that we maintain the right balance in our portfolio in terms of the exposure. If you look at the comprehensive, I can put my hands on my heart and say that we are among companies which are offering higher rates. To be honest, right? Minimum premium, what we are offering and what we see in the market. Huge difference sometimes comes to 20, 30 riyals difference, to be honest, if not more. And so if we want to be a first mover into further loading our prices, that would keep us, outside of the business, to be honest. So we're very careful. We're not into the verge of reducing our prices. We don't want to get into that war, but we are, carefully watching the space and see, whether there's room to do or not. And maybe you would say that, okay, what about, segments, get into segmentation, profitable segment. See, the pricing in this market, in this year and the previous year and the last 3 years, I would say post-COVID-19, in my humble view, it is beyond, it's below than the technical rating across all segments, profitable ones or the loss-making ones, and it depends on each company, which segments and which make and model and body type in their portfolio, is profitable or loss-making. But across all of these, it's underpriced. So if you want to further reduce on what you call a profitable segment, it's not going to help you at all. And so what I feel is that there's a need to see, an increase in the prices, a decent increase, steady increase, not a shocking increase, over the next 2 years to render our business sustainable. Otherwise, you have seen, it's nothing strange. You go and see all performance of all the insurance companies, and you will immediately see that, if it wasn't for investment, most of them would have done negative, minus. So, and it's not going to help.
Noted. Thank you for that answer. Next question would be with regards to your float. If I look at your shareholding, 91.1% is held by 2 shareholders, Oman Qatar and Al Hossain, which actual float of only 8.9%. Now, as per CMA, the float is supposed to be minimum 25%. If you could just provide us with a roadmap of sort of how you see the company being in compliance with that, or sort of what is the strategy around that?
Yeah, let me answer this question. See, in fact, if you see the shareholding, you can see that 55% is by Qatar Insurance Company and 35% by Al Hossain Investments, which is a 50% ownership, Oman Investment Authority and Qatar Investment Authority. So what happens is that when companies go into M&A, this article is waived by CMA. So whatever the composition will be post-merger and acquisition, that is fine by CMA. There are some studies happening through our board and our strategists in the company to consider increasing the free float shares.
But okay, so what timeline would you have to sort of achieve this target? And what's the target float you want to achieve?
It is not the management goal to decide on shareholders. So shareholders themselves are owning this, and if they are willing to reduce the ownership or increase the free float, that call will be taken by them. But there are some studies happening on this, so they're analyzing the position of increasing the free float. In terms of regulatory requirement, it is 100% fine with the regulator.
Okay, so just to recap, CMA had given an exception because it was an M&A. They're okay with the current shareholding, but the shareholders are devising a methodology to increase the public float from the current 9%, correct?
100%, yes. So there is no urgency and no compliance issues for us to address this issue, this problem. It is 100% compliant. It's a decision to be taken by the by the shareholders. And what Muhammad just mentioned now, it is an item on the agenda, on the table of the shareholders to address. And now you might be following all the updates of the industry. So this year there will be elections in the board of QIC, and our AGM is on the 30th. So we will come to know what is the composition of the new board, on the 30th, and then a new board will be formed, and this item will be brought into discussion eventually in the coming board meetings.
Noted. And last question, thank you for your answers. The last question will be with regards to your dividend policy. Now we saw a increase in dividend payout this year. It doubled from 4 paisa to 8 paisa. Historically, we used to have a payout ratio in 2019, 17 and 19 of close to 70% and 60%. But last few years, we've seen it around the 30-35% mark. Just wanted to check, is there a target dividend paisa number you have in mind or a target payout ratio and what that would be? If you have any thoughts on that.
Yeah, so Bishan, in terms of the dividend, we can see that in 2022, despite it was a merger year, we distributed around 4 paisa on a shareholding of 100 million shares. So this year it went to 8 paisa.
4% was a good year.
4% was on. Okay, this year we went to 8 paisa. So this is a clear double in terms of the distribution. So the strategy here is to be a good dividend distribution company. So we are focusing on the dividend, building our books, so we maintain a good dividend payout ratio for next year and year after.
And just see if you see that in 2021 it was around 7 paisa on the total number per share, right? And we had 100 million shares, and then in 2022. Which was paid in 2023, it was not immediately after the merger, at least on paper. And we had to change our the capital accordingly. So that 4 paisa actually, in terms of absolute Omani riyals, was assessed on the year of the performance of 2021. So right, and sorry, on the year 2022, and we paid it in 2023. So, increasing that from 4 to 7 or 8 just to have the same percentage of payout per capital was not the right decision to do. So that's why it might have appeared as we have paid less in dividend from 7% to 4%. Actually, in terms of absolute Omani riyals, it was the same, just the impact of equity, we paid out capital. That's one. Now we come to the performance of 2023 and what the board has recommended for as a dividend, which will be presented in the AGM for the shareholders approval, is almost double. So your question is now, why from the profits last year, versus profit this year, you have paid lesser, right, as a percentage of the profit. Now, last year you are taking the net profit based on the IFRS 4, right, and not IFRS 17. So 3 million versus 4 million. And this year, despite we have done 4 million, let's not forget 1.9 million is non-recurring in nature, right? So, and that's not a cash kind of reward that you have. It's pure merger accounting gain, right? So it's not a real money that we have to disclose. Despite all of that, we want to reward the shareholders as OQIC, for supporting the performance and getting into a merger. So moving forward, I can't speak on behalf of the board. But my understanding, as long as we make profits the same region, same last of presented what we have delivered this year, we should expect the same kind of dividend as a paisa versus number per share.
Yeah, so compared to the net profit, it was 32.5%, whatever we are proposing in the upcoming AGM. And we are looking for similar ratios up and not down, inshallah, but up, increasing it year on year. Subject to performance and of course shareholders' recommendation.
Noted. No, you answered my question. Thank you so much. That's it from my side. Wish you all the best.
Thank you very much.
Thank you, Vishal.
Any other questions? I'm not sure if we have any other participants as well. Any other questions? If no, thank you very much for Auditor for listening and being here. Thank you, Vishen, for asking different types of questions. And I pray to Almighty in this holy month, to shower His blessing to all of us and all of you, and enjoy the remaining of the month of Ramadan. And we will catch up in the semi-annual performance meeting. Thank you very much.